Tony Lombardo is the global CEO at Lendlease. He joins us now live. Tony, good to see you and appreciate your time. And thank you. Stock not doing too well. Investors are not happy. How are you feeling about your earnings?
Well, I think there's some key things on the strategy that we've articulated, and we've been transitioning the business over the last 2.5 years to an investment-led business. And I'm pleased to say our funds management in the last 2.5 years have grown to 48 billion under management, so that's 20% up. In terms of the outlook for the business, our guidance has an expected 7% ROE. In the second half, we're anticipating better performance out of our development business. We've transacted on 12 community projects, which was a $1.3 billion transaction. So we're anticipating that was done at a 20% premium, and we're anticipating some $130 to $160 million of profit. And last week, one of our key developments completed, which was a residential tower here in Sydney. That's going to deliver some 150 million of EBITDA, 100 of post-tax profit. So the visibility to earnings is better in the second half versus the first half. And our guidance, we've given that expected range of 7%. A couple of things that happened in terms of capital markets have been significantly weaker across the US, across Europe and Asia Pac. We're a transactional business, so some of those timings of transactions could either happen between the second half or into FY25. So we've been very disciplined to make sure we're preserving the balance sheet, focused on the balance sheet, but delivering and improving the performance of the company. And then finally, from a business simplification perspective, we announced in July last year a cost restructuring program. I'm pleased to say we're 90% through of that. That's some $150 million of costs that will come out. There's some 60 million of savings pre-tax that will occur this year, and we'll see the run rate benefit from a number of those actions flow through into FY25.
Tony, I tell you what, you're sounding pretty convincing here, but and if you don't mind me sort of paraphrasing, it sounds as though you're saying, look, 2H, it's going to get better now, at least because rates are going to start coming down. What are investors, though, your investors not getting?
I think it's as we transition the business, and that's one of the key things. It takes time to transition a business that's been a heavy developer focused over the last 5 to 6 years, and we're making that pivot transition point. By the end of this year, we had a development pipeline at the start of the year of 120. We'll see that reduced to 90. There's been a focus on realising value out of that development book. We've hit peak capital in production, and the peak capital, therefore, in our development business will start to realise some of that cash flow over the coming 12 to 18 months. So as we now make that transition, people will start to get a better understanding for the timing of some of the things we're trying to drive and really pivot that growth into investments. And I'm pleased to say we're at that 48 billion. I've got 6 billion of new farm in production in the development book and $4 billion of capital that we've raised to deploy in new strategies around value add, which is we're focusing on brown to green conversions of office. And then we're also focused on key areas around life sciences, other core areas we see real good growth coming in many, many years to come.